We stated recently that we expect the RBI to reduce interest rates in October of this year by possibly 25 basis points, or it has the opportunity to do so given the kind of slowing global growth and inflation starting to fall. But how does that look now, given that the European Central Bank has increased rates by 25 basis points, is saying it's going to do another 25 in July, and the US Federal Reserve, whilst they pause, it's a very hawkish pause in saying that we could increase rates at least 2 more times this year, so maybe 50 basis points. So does that still lead to the RBI having the ability to reduce rates? We still think so, because when you look at the underlying factors that impact inflation across Asia, it's going to be oil and other commodity prices, and those are falling because as the economy globally slows, even if it's less quick than we're all expecting in terms of moving towards recession, it still means that it puts less pressure on inflation in countries like India. And what we're seeing is if you look across to China, where we're seeing interest rates actually being reduced because there's a slowing demand, and that's impacting commodity prices, leads us still to the view that the RBI this year still has the ability to reduce rates. Now, whether it's October, it shifts a little bit because of other central banks around the world, we'll have to wait and see. But our view is that, our view has been that once that happens, then the whole of the banking sector would be a great place to invest. Now, we've already seen the banking sector do very well. So if the narrative changes to interest rates kind of falling a little bit later than we're expecting, then maybe we'll see a correction in our markets, which have had a very good run over the past few months in the very short term, before resuming that kind of upward move to our target of Nifty, and by March of next year being nearest to 20,000.